Welcome to the Dinar Chronicle, your trusted source for breaking financial updates and global currency developments. I'm your host, and we are broadcasting this urgent report with real-time updates surrounding the Iraqi dinar and Vietnamese dong currencies that have been the focus of intense speculation, strategic positioning, and high-level coordination for months, if not years. What we are about to share represents a potentially historic shift in the global currency landscape with substantial implications for holders, investors, and international markets alike. This report is coming to you Wednesday evening, and the developments are moving rapidly. Sources with direct knowledge inside international banking systems and connected global financial institutions are confirming that the rate adjustments for the Iraqi dinar and Vietnamese dong are not only finalized, but now posted on internal trading screens as of late this afternoon. As of 5:17 p.m. Eastern Time, both Tier 1 and Tier 2 institutions began seeing the live tradable rate for the Iraqi dinar at $5.21, while the Vietnamese dong was reflected at $3.50. These rates, long the subject of speculation and anticipated realignment due to economic reform and asset backing mechanisms, now appear to be actively positioned for immediate redemption. This is not just rumor or chatter from the sidelines. Several bank sources from regional redemption hubs across the United States, including facilities in Reno, Dallas, Atlanta, and Miami, are reporting confirmed operational readiness. Staff has been placed on overnight standby, and access to updated foreign currency conversion protocols has been granted through proprietary systems, including the QFS or Quantum Financial System Interface. Redemption centers, many of which have been covertly operating under non-disclosure since mid-2024, are now scheduled to open to the public starting tomorrow morning at 9 a.m. local time. This development follows a pattern of increasingly coordinated activity observed in recent weeks. Central banks in multiple regions, including the Central Bank of Iraq and the State Bank of Vietnam, have tightened capital outflows, restricted public announcements, and realigned internal ledger balances in preparation for a significant monetary event. The IMF has remained publicly quiet, but is rumored to have completed a final sign-off over the weekend, following a closed-door meeting in Brussels with G7 and BRICS financial leaders. That meeting, according to sources close to the European Central Bank, revolved around sovereign debt, restructuring, and the realignment of suppressed currencies under a new commodities-backed system. For holders of the Iraqi dinar, this shift represents a monumental change in value from its previously suppressed international trading rate of approximately 1,320 IQD to the USD. This realignment to $5.21 implies a restoration of the dinar's historical value, reflecting Iraq's substantial natural resources, chiefly oil, and its integration into broader global trade systems. Iraq's recent contracts with China, Russia, and the US, all of which are denominated in non-USD terms, have been widely interpreted as a signal of de-dollarization and preparation for sovereignty and valuation. In the case of the Vietnamese dong, the rise to $3.50 marks a substantial departure from its long-held peg in the neighborhood of 23,000 VND to the dollar. Vietnam, one of Southeast Asia's most dynamic manufacturing economies, has long maintained a weak currency to attract foreign investment and maintain export advantages. However, with a growing middle class, robust GDP growth, and increasing global reserves, reportedly north of $120 billion, Vietnam has been under mounting pressure to allow a fair market valuation of its currency. The move appears to reflect an intention to reposition the dong as a stable and valued currency, particularly under regional economic initiatives like the RCEP and the Belt and Road Strategy. As of this hour, individuals holding IQD and VND have been advised to monitor their emails and phone contacts closely. High net worth individuals and group redeemers are being contacted directly through registered Treasury authorized channels. Redemption appointment notifications are already going out through secure platforms, with some Tier 3 groups reportedly beginning the scheduling process as early as this evening. There are also credible reports that certain banks, including HSBC, Wells Fargo, and Bank of America, have activated specific in-branch teams under the currency exchange and wealth management divisions to assist in high-value redemptions. These branches, operating under enhanced security and off-hours protocols, will provide private rooms, non-disclosure processing, and structured payout options for qualified currency holders. The vast majority of appointments will occur at off-site redemption centers, many of which are attached to regional Federal Reserve facilities or operated under the umbrella of the U.S. Treasury Redemption Program. As always, the implications of this move are vast. Currency reevaluations on this scale have not been seen since the Bretton Woods Agreement or the currency realignments that followed World War II. We are watching, in real time, the unfolding of a global monetary shift that goes far beyond individual returns or private exchanges. This appears to be part of a broader asset-backed transition linked to Basel III compliance, which requires participating banks to hold physical assets against digital representations of currency on their balance sheets. This requirement, long resisted by fiat-based systems, now seems to be forming the foundation of the new financial architecture. The ripple effects will be immediate, and commodity markets, particularly those involving gold, silver, oil, and rare earth metals, are expected to spike. Foreign exchange markets are likely to see volatility in the coming days, especially as arbitrage opportunities emerge between institutional rates and public release rates. Financial advisors are urging caution, reminding investors not to make rash decisions based solely on rate projections. But the trend is unmistakable. We are transitioning from a fiat-based model into a system where national currencies reflect sovereign wealth, production, and natural resource reserves. One of the most significant indicators supporting the authenticity of these moves is the confirmation of internal codes being released for redemption processing. These codes, previously dormant in the banking system's backend, have now been activated for both IQD and VND, allowing currency validation through specialized scanners and serial number tracking software. The system's being used to integrate with Treasury oversight modules to ensure compliance, authenticity, and transactional traceability. Some banking insiders have raised questions about the tax structure on redemptions, and while no official IRS guideline has been publicly released as of this broadcast, early reports suggest that structured payouts and asset conversion instruments will offer considerable tax efficiency, especially for those opting into Treasury-backed vehicles such as bonds or infrastructure-linked digital certificates. It is essential, however, that anyone planning to redeem significant amounts consult both financial and legal professionals before making irreversible decisions. Security remains a top priority. The Department of Homeland Security, in conjunction with the Treasury and certain branches of the U.S. Military Financial Command, is overseeing the protection of transport, data, and facility access during this transition period. Satellite banking centers have been secured and geofenced, and all redemptions will require biometric verification, legal documentation, and a fully vetted appointment process to ensure compliance and avoid fraud. As expected, the mainstream media has yet to fully cover this development, whether due to non-disclosure agreements, national security concerns, or editorial hesitancy. The current coverage blackout may persist until the first wave of public appointments begins. However, insiders are quietly acknowledging that this monetary event will be difficult to conceal once liquidity begins to move across large financial channels, particularly if Tier 4B redemptions considered the public-private sector hybrid tier begin, on schedule tomorrow. And finally, a brief but necessary disclaimer. While the information presented here is based on multiple high-level sources and banking confirmations, this report contains elements that remain subject to fluid geopolitical, economic, and institutional dynamics. Until publicly confirmed by sovereign governments or global regulatory bodies, these developments should be considered speculative in nature. Listeners are advised to conduct their own due diligence and seek independent financial counsel before making any decisions related to currency redemption or investment.